Kitco News special coverage of the Precious Metal Summit is brought to you by Nucor Gold.
This is the first day of our coverage of the Precious Metal Summit in Beaver Creek, Colorado. Beautiful city, ugly day for the markets. John Feneck joins us today. He is the founder of Feneck Consulting. Welcome back to the show, John.
Thanks, David.
We'll be revisiting a lot of your calls that you and I discussed 2 months ago in Toronto at PDAC. But let's recap what happened today. The biggest single day loss for the equity markets since June 2020. So in the last 2 years, we have not had a day that has been this bad. I'm just going to recap some of the indices now. 4.3% down, the S&P 500. The NASDAQ was down 5.1%. Bitcoin is down 9%. Gold, supposedly a safe haven, is down 1.5%. The dollar is up 1.4%. John, this is what happened today. We know the CPI numbers came out, and we'll revisit the numbers, but it can't just be the CPI running hotter than consensus, right? Remember, headline CPI came in at 8.3%, which was lower than 8.5%, but still, lower than last month's number, but still higher than consensus. This is what spooked the markets? Really?
Yes, really. Welcome. Thank you for having me back. It's always a pleasure. The estimate was 8.1, and we got 8.3. So there was a lot of Wall Street expecting a 7 in front of that number, and we didn't get it. We're starting to see that the Fed's endgame of 2% inflation or whatever they're talking about is going to be a joke. Inflation is here to stay. You saw that, in the food and energy area. Well, food and shelter actually went up. Energy went slightly down. But food and shelter is what affects the average consumer, correct? I mean, it's like, energy to some extent, but you've got to, pay your mortgage. You've got to get that food at the supermarket. So it's really painful to see that number go up.
Right. So let me just recap some of the numbers from the BLS report. So like you said, food and energy, a big part of our everyday expenses. But if you strip out food and energy from the CPI, in other words, if you just look at core CPI actually rose to 6.3% from July's 5.9%. And this is significant because people always talk about, energy is leading the inflation, and to some extent you could argue that it is. But I think today's print showed that even if you take out energy and food, the rest of the index still went up.
Right.
So inflation didn't go down.
Right.
This is
that's what spooked the markets.
So what could you attribute this persistent inflation to at this point?
Well, I can just say that going to large places like a Target myself, in the first quarter, I wear contacts. So contact lens solution was $12.99. It was $17.79 when I went there this weekend. Yeah. So is that Bausch & Lomb raising prices, or is it Target raising prices? Either way, the consumer feels it, right? And so when you're dealing with stuff that you use on a daily basis going up like that, whether it's that, hamburger meat, milk, it really impacts the consumer. And the rally that we saw the last time we met, the S&P was down almost 20, the NASDAQ was down almost 30 back in June. We saw the summer rally, right? We saw the S&P, the NASDAQ, and the Dow, all three major indices, get to within about 1% to 2% of a breakout in August. And then we saw that huge option expiration day, August 19th, where the markets tanked. And the following Friday, August 26th, we saw the Powell speech at Jackson Hole, which was about 8 minutes of pain, but it was painful because the market really reversed. And so when you see rallies like we just saw prior to today, I think they're head fakes. We're still in the construct of a bear market in the broad market.
I'm going to come back to CPI, but this is what surprises me is because, like you said, at the Jackson Hole meeting a couple of weeks ago, Jerome Powell, Fed chairman, was dedicated, very committed to fighting inflation. He made that unequivocally clear. I'm just surprised that the markets either A, didn't take him seriously at the time because clearly things were down. I mean, this should have been priced in, right?
Well, when you look at his comments, August 26th, we took it very seriously. We went short more, on that day, and we shorted more over the last week or so when the broad market rallied because as I tell my followers, you have to pick a direction, right? If you think things are going down, then you use days like the last 5 or 7 business days to short more because your conviction is the market is still going down, correct? Yeah. So when you have a daily today, you're already positioned, right? You're ahead of it. Today just fed on itself, and it was really ugly price action. And I may just remind listeners that September, going back to the 87 crash, is the worst worst month for the market, broad market that is, in history. So it's a tough time right now. This kind of cements for me a 75 basis point hike in September. That's on the 21st. So now if you look at March to September, you're looking at a 6-month period where the Fed will have raised rates 3%. That's super painful.
Let's touch on that real quick. The Fed Watch tool, which tracks the probability of a rate hike. A week ago, the probability of a 75 basis point rate hike I checked was about 80%, the number that I saw. Just right now, I'm looking at it, it's down to 66%. Just this morning, it was at 76%. And actually, where did the other 34% go? Well, it went into 100 basis point probability. So the markets are pricing in a higher chance of a 100 basis point rate hike and a smaller chance of a 75 basis point rate hike after today. I find that very interesting.
A 100 basis point hike would be very detrimental to the markets because now everyone's back at their desk, right? Everyone's paying attention to September's action. I do believe 75 is still on the table, and that would mean that you've had 300 basis points of hikes now from March to September 21st.
So you think that a 75 basis point rate hike is on the table, but is that, do you think a 100 basis point rate hike is on the table? Do you think at least 75 basis point, or do you think that's it?
I think the Fed is going to guide us into this rather than do 100 and then another 100 and then shock and awe. That's going to really, disrupt Wall Street, big institutions, and I don't think that that's what Powell's end game is. Okay. It's like we have to get to a higher place. You said to me in June when we interviewed that I was the only gold, expert, if you will, that was talking about higher rates, into the fall, sure, and not a flip-flop, because I see that the Fed's positioning reminds me of August of 16 when Janet Yellen at Jackson Hole, interestingly, said, we're going to start raising rates. And you remember that rate cycle started in 16 and it ended in January of 19. So are we going to see another 2 years of this? No. But I think it's interesting that some of the Fed people like Mester were talking about no rate cuts in 2023 just last week. Right. So,
well, given that you think that it's, let's say, unlikely that they're going to raise by 100 basis points, would you not make the statement or the assumption that markets overreacted today? Because it seems to me like things tanked because people expected a higher percentage rate hike, perhaps even 100 basis points.
Like I said, I think people expected something with a 7 in it. So the estimate was 8.1. They were hoping for 7 something, seeing that decline, right? Seeing that we've peaked in CPI. Now today's numbers show that we didn't peak in CPI this summer. It shows that we may still see a persistent inflation number despite the Fed's actions already. So that's what's scaring most people in my view.
So basically investors are thinking to themselves, even with what the Fed is doing now, it's not working. They're going to have to really jack up rates to make a difference.
Correct.
Where do you think that's going to go then? Ultimately, is there a level at which inflation finally comes back down?
We've been calling for a Fed flip between December of this year and March 31st of next year, right? So we're still in that camp after today, but this might push it a slight bit further back. It just depends, right? You have to look at outside events like what's happening in Russia, the jargon coming out of China versus Taiwan. Like these are events that you could see the Fed pause briefly and say, let's just take our foot off the gas here because we see some international events that, are going to, really roil the markets. And I still think that kind of stuff is on the table. Russia and Ukraine it hasn't changed since we last interviewed. China has gotten more aggressive with the Taiwanese situation since we last interviewed. I think these are things that people need to be looking at, and we're heavily short international right now.
There's speculation that Russia and Ukraine might reach some sort of peace deal, maybe before the midterm elections. Suppose they do. What impact would that have on the markets?
Oh, that would be very bullish for the broad market, and we would cover a lot of our shorts. Yeah, okay. Absolutely. And it would roil the energy markets because you're seeing, oil and gas at elevated levels, partially because of what's happening with sanctions against Russia.
So we talked about your forecast or your outlook on Fed policy. Let's touch on your outlook for inflation itself then. So 8.3%. This is the second month in a row that we've come down from the 9.1 in June. What's your outlook on inflation? Are we going to stay persistently high above 8%, or are we going to keep coming down?
We've been saying since last spring that inflation is going to be persistently high, and we hold true to that right now. And I think that the Fed is in some sort of dreamland that 2 to 4% is even achievable. I mean, it's going to take a lot more rate hikes and a lot more hawkish behavior to get to where they want to be, and that's going to really hurt the broad market. Hence, why we don't own any of the broad market right now, and we're shorting things that look really, elevated to us.
Okay, I'm going to come back to your picks and your investment strategy and your portfolio allocation. Do you think the Fed needs help from the Treasury, from the Congress?
Absolutely.
Fiscal policy needs to be less accommodative as well.
Yeah, they could. I mean, Powell can't do it all by himself. He needs assistance. What making matters more complicated, of course, is Election Day coming up November 8th, I think it is. So we're all eyes are on what's happening there, and I'm not a politician. I don't. All I know is that as a market guy, I think that you have to watch that too, right? Yeah. So between now and then, you're looking at just under 2 months. And in 2 months, you can lose a lot of money. So, we've built up cash and we're building up shorts as a result.
All right, let's talk about your market outlook then. So last time we spoke in June, that was actually the trough of the stock markets. As you recall, throughout the rest of the summer, stocks started rebounding up until basically today. Well, actually a couple days ago, but today was especially bad. Why the rebound over the course of the summer? What changed in sentiment?
I have no clue. We weren't going to buy that. We were watching very closely leading up to August 19th option expiration. And on that Friday, as I mentioned, all three major indices failed to break out. That's when we went heavily short. And then
breakout of what, sorry?
So the S&P, Dow, and NASDAQ were all close to breakouts, meaning breaking above resistance, and they all failed there.
How did you define your resistance level?
Just looking at some technical websites that I look at, yeah. I mean, but that would have been, to your point, very bullish for the broad market, right? Because they didn't break, however, and so then we looked at that as a negative. And then 5 business days later, the Fed comes out with that hawkish speech at Jackson Hole, which gave us more incentive to short. And then you look at the price action from August 26th to today. To your point, it was a rally based on what? It's just greed. It's just greed.
So where are risk assets, stocks, cryptos headed from here?
I don't follow anything crypto, but as you pointed out,
I'm just lumping in cryptos because so far they've been correlated, but we'll stick with stocks. Yeah.
Yeah, I mean, I think my outlook is the S&P is going to break 3,900, and it's going to unleash a lot of pain. And because 3,700 is probably the next target from there, and then you've got major support around 3,200. But if we even touch 3,300, there's going to be a lot of people wishing that they would have taken more care of their 401k and general investments, right now.
Yeah, we're at 3,900 today. 3,200 is a 700-point decline. Some quick math, that's roughly a 20% decline. 15-20% decline.
I don't think that's out of the cards, but I don't think it's going to happen right away. I mean, it's going to take, I'm talking within the next 3 to 6 months, but a 20% decline even in 6 months is going to be super difficult for a lot of people to handle.
Do you think there's anything the Federal Reserve can do would do, let's not say should, but let's say would do, that might reverse your outlook, that might make you more bullish?
Absolutely. So if they flip-flop like we talked about last time, I'm going to cover all my shorts and go long a lot of stuff because I'm building a list of things that I like, right?
What would they do to signal a flip-flop?
They would just pause, or they'd actually cut rates. A rate cut here would be like your indication to go buy a bunch of stuff. Well,
you were right last time. Let's talk about another call that you made last time. We spoke right before Q2 GDP came out, and you said that a technical recession would be in the cards. Yep. That turned out to be the correct call. Now, let's talk about that. So we are in a technical recession, despite the fact that the White House is denying that a formal recession is taking place. But to your point about a flip-flop from the Fed, that could happen. Suppose this recession gets worse. They may be forced to give up their fight on inflation and help recover the economy. Right? Which side of the battle are they going to pick in that case?
It's anyone's guess. I mean, I just try to follow daily and weekly activity. I don't look out like a year to 3 years. It's useless in this market. You have to really be dialed in on a daily basis. And what the market is telling you today is it's like a little child that didn't get their toy, you know? They wanted a low print on CPI, they didn't get it, so they basically just sold everything. It's like, you gotta be careful because as a retail investor, you're a pawn in this game, right? The big boys are Goldman, Bank of America. Like, these are the shops that are pushing things in one direction or another. And I should mention, Goldman just upgraded Newmont, Agnico Eagle, and Wheaton just yesterday. I think that's very bullish. So someone's taking notice that Newmont's got a 5.5% dividend right now, which is positive.
Okay, so we talked about your outlook for the stock market. Let's talk about your outlook for gold, but let's recap what happened today first. 1.5% decline. Gold's supposed to be a safe haven. What happened today?
Well, gold is you saw the gold price really decline in March of 2020. That was because of margin calls. And so that was probably part of that today. People selling something to meet calls on Bitcoin, for example. If you own gold and Bitcoin's down 9% today, well, you've got to prepare for maybe further losses, and you've got to sell some stuff that you don't want to sell. In the portfolio management world, this is very, very true. If you look at 08, 09's correction, I know so many people that own stuff they really were in love with, but they had to sell at any price because redemptions kept coming in. And that's the kind of day we had today.
Okay, you don't think it's because gold reacted to the possibility of higher interest rates?
I think gold reacted to the higher dollar today. Okay. The higher dollar is a persistent problem. 1675 has proven to be a pretty good support level. But, when you look at 1675 possibly breaking, then you have to look at 1575, which was, yes, per ounce.
All right, well, that's not too far from where we are. We're at 1715 today.
Yeah, so 1675 has held a couple of times now, which is very bullish in my view. Okay. So if we can hold 1675, that's very bullish for gold and gold stocks.
Well, let's put everything together, given your outlook on the Fed, on inflation, on stocks. Where does gold fit into your medium-term picture?
I have zero gold exposure, the metal itself. I do own gold stocks, and we can talk about a couple of those. I think there's some really good leverage to the gold price, and people are missing out because they're not. Look at Newmont, for example, okay? It topped out around 86.50, I believe, a few months ago. Yeah. It hit 40.27, which was 6 years ago, the resistance level, and now it's acting as support. That's exactly what you want to see, and it bounced really sharply from 40.27 to about $44 recently. So, that's showing you that someone is paying attention to a 50% decline in Newmont, and it's not even close to that in the actual gold price, right?
It's very interesting the way you phrased that answer. You say you have no exposure to gold itself, and while that is technically true, some people in your position might say, I have exposure to gold through the miners. But they still consider that exposure to gold. I'm just trying to pick your brain here. Are you
to the price of gold, the actual commodity? I don't own physical
gold. So you're not investing in the miners as a play on gold, and that kind of touches on your philosophy.
I'm a value manager, so when I look at something going from 86 to 40, I'm super interested if it's a high quality name like Newmont.
Cool. But just going back to my question real quick, do you think gold's going to go up or down by the end of, let's say, next year?
By the end of next year, up. Yeah, absolutely. Yeah, next year's going to be a good year. Because we're going to start, if my thesis is correct about the S&P going down another, 10, 15, 20%, people are going to look at other asset classes, as Goldman just did yesterday, and saying, this is worth an upgrade, That's the dynamic we saw from 2009's rally into 2011. People started to upgrade names that had dividends.
I would ask you what exactly would be the catalyst to push gold even higher. Some people might say that a high inflation print like we saw today, where higher than expected, would have been the perfect catalyst for a higher gold price, but gold, for the reasons that you mentioned, went the other way.
Right. I think the catalyst is patience in our sector, and most people don't have patience, right? Our sector peaked August of 2020. It's been 25 months of pain in my view, because it's been not a straight line down, but it's been a jagged line down. And most people have bailed along the way. We saw some really big selling of some junior names in July and August of this year. I simply believe we're getting close to a bottom. A couple things to point out there. the gold-silver ratio, which is simply an ounce of gold divided by an ounce of silver, hit 95 recently, hit 95.39 to be exact. And when it's hit 95, only 2 other times in history that's happened. And both times were great buys for our sector. So, timing the top or the bottom of anything is extremely difficult. So we look at that and say, well, hey, let's deploy some money into some larger cap names, like we just mentioned, that have a dividend and have a real history of success. And we don't know if this is the right entry point or not, but we're going to put a little money to work. Now, in the junior space, last time I mentioned a couple of names on your show.
Sure.
Golden Minerals, AUMN, remains our largest silver holding. Their decision to restart Velardania was delayed because they looked at the silver price declining and smartly said, we can't, feel good about doing what we were going to do here because we're not going to make as much money as we had hoped, right? If you have a silver price at 22 when we last talked, and now it's at 18-ish, that really makes a difference when you're producing. I still like the stock. That was at 35 cents on our last visit, and now it's around 25 cents, so we've been clearly wrong on that. But I know management very well, and I've owned the stock on and off for 7 years. Another name that we mentioned was our largest palladium holding, which was DCNNF, Canadian Palladium. And looking at their website, they haven't had a news update since April. When you don't update the market for that long, people get frustrated, they sell. But in talking to the company on a regular basis, as I do, that's one of the things I think it's critical for investors to keep in touch with these companies and make sure they don't get derailed, by lack of news. Because I still think they're in a great area. They're building a starter pit. They've got interest from people looking at the projects. And I think it's a steal here at 4.5 cents.
You mentioned that you don't have broad equity exposure, and you mentioned why you think stocks are going to go down overall. By that logic, wouldn't you stay out of all stocks, especially things as speculative as juniors?
It's a good point. Look, I have 80% of my money invested in our sector. I'm an advocate for the sector. There's a lot of people I compete against, and you've interviewed, that have 20 grand to 100 grand at risk. I'm not trying to put them down. I'm just saying that's not a lot of money, to be having like a following, right? Like I take my job very seriously, and I'm not going to give up on this at this point. It's not stubbornness. It's simply, as a value manager, I see value. Yeah. So to give your listeners a couple of new names, so we have one base metal name that we've been looking at for a long time. In full disclosure, the liquidity is not wonderful right now, but that could change. It's Vendetta, which is VDTAF. They are lead and zinc in Australia. They could be in production in 24 months. They are basically just super undervalued versus their peers. And we think that, the stock could easily go up 50 to 100% from here within a year. And we look at the copper palladium markets closely, as you know. One that does both is Braveheart Resources, which is RIINF. Braveheart's trading right now at 0.036 cents, which is almost the pandemic low. There was a Calor Capital put out a piece last week that has them at 39 cents Canadian. They're trading at 5 cents Canadian right now. So when we see this kind of value, look, if they're wrong and it's at 20 cents, the stock goes up multiples from here. We know that they're talking to the First Nations right now. We think that those negotiations are going well, and they extinguished $5 million in debt recently. So we look for opportunities like that where maybe the market has missed something. And lastly, I'll mention one in the cobalt space because I haven't talked about cobalt before. Cobalt's heavily needed, globally, obviously for the EV battery market and other markets. 70% of it's produced in the Congo, which most people don't know. In Idaho here in the States, it's actually a pretty interesting cobalt revolution going on. And this company, Idaho Champion, has 660 claims in Idaho, which is the largest of any junior company. The ticker is GLDRF. Jonathan's a fantastic CEO. He works super hard, and I think he's going to find a path to success here for shareholders.
You seem to be shifting heavily into the base metals.
I'm always diversified away from gold and silver, unlike a lot of my peers. I don't believe in just precious metals because there's so much opportunity out there.
Okay. But that's not a particular theme that you're writing on?
No, I don't think that like cobalt's better than copper or copper's better than gold here. I think that silver looks really interesting because of the gold silver ratio we pointed out, right? Like silver is super bombed out. It could go lower though. I mean, we mentioned that in your last program that we thought the 18 to 19 range would be hit, and it was hit.
I'd like to end on the seniors. It's not necessarily something that we've discussed so far, but it does affect the space overall. Goldman Sachs just initiated coverage of Newmont, the world's largest gold producer. Their analysts said that it could jump more than 20% from current levels. It's been beaten down a lot over the last year, as you know. I'm just going to read an article from CNBC about this. Analyst Emily Cheng initiated coverage, and she said in her report, recent underperformance marks an attractive entry point for a low-risk gold producer delivering volume growth. So a few key points there. I think valuation is a key. She's looking at this, Goldman is looking at this, stock is being beaten down, value is attractive. Could you say the same for the rest of the space, or is this Newmont specific, you think?
Newmont's a bit of an outlier in that the yield is so attractive at 5.5%. You know, a lot of majors are at 1 to 2% still.
Talking about dividend?
Yes.
Okay.
And I think you need to see more companies think about delivering some type of dividend to shareholders. Another one that looks pretty attractive is BTG. They're around 4.5%, right? But, you know, when you look at the whole large cap space, you can't just buy it right now and set it and forget it. You have to look at interesting names like Newmont by themselves and say, let's start here, then let's go with another one, and then maybe buy GDX, but don't just buy GDX or GDXJ here blindly.
Well, both the GDX and GDXJ underperformed gold. You wouldn't make the, I guess, generalization that the sector as a whole is undervalued?
The sector is very undervalued. The question is, how much more could it spike down if we have another day like this tomorrow or the next day or the next day? It's like, as Rick Rule once taught me, you know, mining stocks are equities. They're going to be, you know, affected by equity movement, right? So like you have to be cognizant of the fact that a cheap price could get cheaper.
All right. Well, John, excellent discussion today.
Thanks, David.
And we'll follow up again soon. Thank you for coming on the show, and thank you for watching Kitco News. I'm David Lin.
Kitco News special coverage of the Precious Metal Summit is brought to you by New Core Gold.